Hello, good morning. It's Monday, 24th of June, the final week of the month before we move into the second half, and also a week where where most of the activity or focus is probably going to be the G20 meeting in Osaka, which begins on Friday. It's having an impact on some of the markets overnight. Stock markets are relatively quiet. If you can look at the first chart here, which is the S&P, we can see we did make just peak above these recent record highs, but just connecting the recent highs, we can see we haven't really seen any takeoff at this stage, even though the Fed's punch bowl, as the market is calling it, is back in force. The market is still looking for up to a 30% chance of a 50 basis point rate cut into the July meeting. So plenty of focus on G20. What can be achieved? Well, at this stage, the market is obviously hoping for some kind of a deal, or at least hoping that additional tariffs will not be slapped onto Chinese imports into the US. But we have seen some comments from both sides, which can create a certain amount of confusion as to how much willingness there is to achieve a deal at this stage. But the fact that they are sitting down to talk, I think is obviously a positive first step. Moving on to some of the other, moving on to the currency markets, we did have a breakdown last week. The dollar bear seems to be back in control. They haven't been that for quite a while. We did see that this is the dollar index. We can see the uptrend from September last year was broken last week. We also took out the 200-day moving average. So the market is now looking down towards this the recent low from March, which was at 95.74. So at least the market is now looking for some additional momentum. Taking a look at the speculators, how they reacted, we can just stay with the chart here because that just indicates how the positions have been developing. If you look at the dollar in the futures market, this is the aggregate dollar position against 10 currency futures. And last week, up until last Tuesday, June 18th, just the day before the FOMC meeting, there was quite a substantial reduction. That was the biggest reduction in dollar longs in 16 months. So the market was already starting to smell something was up, looking for the Fed to confirm the dovish stance the market had been building, and the dollar was suffering as a consequence. If we look at the table on the right, it's relatively small, but we will send out a report on which you can access by going to analysis.saxo. We can see the biggest change was in the euro, where there was quite a substantial drop in the I think it was a 40% drop, as we can see there on the top line. So the euro short is starting to be scaled back, and we can also see the market is breaking higher. As long as it stays above 113, according to my colleague John Hardy, then there could be some additional upside. So longs we probably look for that with a potential stop below 113. Staying in the currency market, we also had some news out overnight from Australia. The RBA's Lowe, the central bank head, basically was out questioning the potential impact of cutting rates further, basically saying that well, if everyone else is cutting, the impact is going to be limited. He instead of that, he alluded to the potential for the government looking at some more infrastructure spending, and this whole debate about monetary versus fiscal spending is probably one that's going to heat up over the coming months, as the market potentially gets to the realization that even though we are seeing rates being cut, the potential impact on the economy in terms of getting a pickup may be limited. So the Australian dollar picked up overnight, as you can see. It's now been putting in a daily performance or positive performance 5 days in a row. That's the first time we've seen that this year. So a little bit of a question mark about how much aggressive easing we can expect. Maybe 1% is the floor that for now. Staying with interest rates and the impact on currency markets, the Norwegian krone is on the move. It's strengthening because if you look at within the D10, the biggest divergence we currently have in policy divergence is between the US and Norway. We know that the market is pricing in further cuts in July from the Fed, whereas the Norwegian Norges Bank at the meeting last week, when they raised rates, signaled that they were prepared to cut again, hike again in September this year. So Norwegian krone is benefiting from this widening yield gap, and we can see the next level is down towards the 840, which is now starting to come into focus. That really is going to be the key, whether we are going to stay in this range that has been established since December, or if we can see the Norwegian kroner break further to the upside. One thing that may help determine that is the crude oil market. We have seen the crude oil quite a strong rally last week based on renewed concerns about the Middle East, and we've seen that market continue to tick higher this morning. We're getting some confusing signals out of the US, and I think that's also why the market is just erring on the side of caution. We've had some comments over the weekend. We can look at the chart here, where it just looks like Trump is applying his carrot and stick approach once again to a country. Once they say indicating he doesn't want a war with Iran, at the same time say he's open for talk. So what it's going to be is obviously remains to be seen. There is still some concerns that there are certain members within his inner circle which are looking for a conflict, and that is creating some uncertainty. Obviously, also whatever response we may see from Iran as it gets squeezed even further after sanctions, again with Trump's carrot and stick, basically saying that he's going to apply additional sanctions today, Monday. So we're going to see what that entails. But staying with the chart, we can see how we have returned to the 38.2% retracement of the sell-off we had since April. So 65.60 right now is the level to look out for. A break above that could give another dollar to the upside, 67.50, and then we'll basically, I think the market will start to also have an eye on G20, because if there is no deal at the weekend, the risk of a trade war continue to be extended is obviously having a negative impact, or could have a negative impact on global demand growth, and that is probably going to keep the market capped at this stage. But geopolitical risk just in the short term, the main driver. One market that has benefiting really greatly from all these recent turmoil and uncertainty is gold. We broke above 1,400 last week, and we've actually managed to stay above there so far in this Monday session. As you can see on the chart here, we broke up on last week following the very dovish FOMC meeting, and I think at this stage, with a lot of new longs into the market, they obviously wanted confirmation that we're not seeing a new high, but instead a potential new low, and that's really what's going to be the focus of the coming days. I think as long as we stay above these two previous highs, 1355 and 1375, or 65 and 75, then there's not going to be any major nervousness creeping back into the market. So for now, these are my two key levels to the downside. Next level of resistance is the local high we had back in 2013, which is further above at 1433. Staying with the charts, because what are the drivers? We can see right now that there's been a massive rush of speculators moving back into gold up until June 18, so before the FOMC meeting, which is probably has attracted additional buying. We saw a 3-week run of buying, which has not been seen on since data was started to be collected in 2006. So a lot of new longs has entered the market, and obviously, as I mentioned, they need confirmation that this is a breakout that we've been looking for now for the past 4 to 5 years. Another way of reflecting the impact of interest rates on gold, we have seen this interest rates and yields come down quite substantially, especially in the US over the past month. It has been one of the key drivers for gold. Adding to that, the dovish shift from the FOMC. But just take a look at the chart here on the right. This is basically highlighting the number of the outstanding amount of global debt, which is which is now yielding negatively. The peak we had in gold back in 2016 coincided with the big rally we had in bonds that year, where we, especially in Europe, where quantitative easing supported return to negative yields in Europe. And this time round, back then we peaked above $12 trillion. Now that just last week we moved above $13 trillion worth of bonds yielding negatively. And again, this is one of the key reasons why gold is suddenly starting to become attractive once again, because if you are looking at a secure government bonds in Europe, you basically have to pay 30 basis points holding a German 10-year government bond, and with that is adding some additional support to gold. So we're keeping a close eye on these developments. If that continues to rise, that will continue to apply some support. Just before we move to the calendar, just to take a look at the commodities positioning last week. Again, this is the table I produce every Monday. I will send out a report again on analysis.saxo in shortly, but we see the biggest winners last week in terms of buying interest were quite broad based from WTI crude to gold, silver, and to some of the key agricultural commodities. commodities. The biggest loser, natural gas, where we're seeing a slump to more than a one year high in the net short. We are seeing the temperatures in the US just not picking up really to offset that the continued increase in production from shale. So US natural gas is trading at this lowest point for this time of year in 26 years, and we need to see basically a heat wave now in order to support the price. But if we should see a market change in temperatures in the US, we're moving towards a much more hotter temperatures, that could trigger a short-covering rally in that gas. So that's just one you need to keep an eye on. And just finally, on the macro calendar this week, as I mentioned, it's fairly light. The key event is really going to be the G20 meeting coming up in Osaka this Friday, where Trump and President Xi will meet on the sidelines. And this is obviously what the market is what the market will be taking a look at this week. But today we have the German IFO here at 8 GMT, followed by Chicago National Activity Index late in the day. But as I mentioned, it is going to be a wait and see. We are also seeing probably some end of month position adjustments taking place. We'll take a look at that later in the week. I'll be joined by John Hardy tomorrow, and until then, have a safe trading and see you then.